Out more from Ashraf Laidi. He is Chief Global Strategist at Citi Index. Joins us bright and early from London. Great to see you. Good morning. So if the ECB is the only one that hasn't been bulking up on its balance sheets, whereas the other majors have, then does this mean that the euro is far undervalued?
Yeah, I'm not sure if it's far undervalued, actually, if you want to go by these statements. Jean-Claude Juncker, who is the commissioner there of monetary affairs, said that he is worried that the euro may be artificially overvalued. I think what the euro is playing really is a case of catching up. And, you know, Friday's repayment of a third of the first LTRO was a further implicit tightening in a way, because some of that money was taken out of the system. Excess liquidity in the euro monetary system did go down by around 100 billion, but I would not call it that there is a drying up of liquidity. It's just that it's a relative reduction compared to, as you very well know, what the Bank of Japan and the Federal Reserve are pursuing, and most probably, inevitably, the Bank of England, as it's likely to pursue another campaign of asset purchases.
Yeah, so then explain to us, the euro dollar at 11-month highs right now, is this fair value? Because we continue to see credit not really flowing through whether the economy or even the companies or even households seeking mortgage loans.
Right, that is true, but what is flowing, or what is flowing back, is actually fund money. As we just learned, we're just saying over 100 billion flowing back, and there is sort of a net positive after 4 quarters. Some people, but as far as, so from investment flows, as somebody put it, Eurozone is now an investment area or investable area. We here at Citi Index, we have been calling for 135 back since September. We did not get that in the projected target of November, but we never threw the towel, not out of a stubbornness, but out of basically looking at the dynamics, looking at the flows, not at all buying, never buying this idea that the ECB was going to cut interest rates. We are now revising the target from 135 to actually 138 and even 139. We're likely to see this early this quarter. And we even like the euro against the Canadian dollar. We expect it to go towards 140. And we continue to see the euro rising against the sterling, going in there now in the 88 and the 89 level.
Okay, so euro sterling also going up to 88, 89. But does this talk about adding stimulus, whether you look at Spain, and even the fact that the shorting bans for equities, that's coming to a halt for both Spain and Greece, does the dose of risk appetite actually propel you to seek a higher target for euro dollar?
Yes, because the part of the reason that we are pursuing the higher euro is not only related to a dynamic that has been playing out, which is equity indices or rising appetite, but like we said, it's the relative monetary policy flows, and you know, and also the technical flows. And as we saw right now in the futures market, the net longs right now in the euro, what used to be seen as just a short covering rally, meaning the euro, it's going up because people are closing their longs, is gradually transforming into a full-fledged rally. It is actually easier when you look at the market and you say, look, this is where the higher, this is where the objective was. We look at a chart of the euro, and you look to the left, and you see higher levels like 140, 145, 143, and it's slightly easier for right now to make a story, to make a case, whether a technical or a fundamental case, for this currency to go back to those levels. But like you indicated, the equity indices story is certainly helping. Maybe one of them is the IBEX in Spain. That's the one we like to break out. We like to see a breaking out of the consolidation range of around 7,800, and we'd like it to go probably towards 9,000.
Wow, so much risk appetite out there. And in the next coming days, we'll see whether we march towards that 9,000 for the IPEC. Thanks so much for that. Good to talk to you. Ashraf Laidi from the City Index.